Hello and welcome to this brand new episode of Smart Money. Today we talk about the big learnings from several past market cycles and try and understand how to protect your portfolio in a market down cycle. My guest who's here with me today in the studio is Ravi Dharamshi, the founder and CIO at ValueQuest Investment Advisors, which is a decade-old PMS firm. Now, Ravi manages the VQ Platinum PMS scheme, which has recently been awarded 5-star PMS rating by PMS Bazaar. Not just that, Ravi has been a stock market observer for over 20 years now, spending a few years at Rare Enterprises, which we know is the family office of Rakesh Jhunjhunwala. And he is well placed perhaps to help us compare the earlier market cycles to understand where we are now. Ravi, thank you so much for being
Sonia.
with
Glad
me on. And I'm so glad that you're here with us personally in the studio. You know, it's after 2 or 3 years that we're getting guests back. It's a great feeling, right?
Absolutely.
A return to normalcy. All right. But before we try and understand what cycle we're in right now, Ravi, can you help us with a bit of a background? What parallels can you draw from history about different market and economic cycles of growth? And how can you correlate that to what we're seeing right now?
Yeah, so let me jog your memory a little bit. I mean, if you have been an observer yourself in the past, so India has not really had a big boom period, you know, so to say, since liberalization started in 92. There was a lot of promise that India's capital markets are going to boom. But in fact, what happened was that markets peaked in 92, and for a period of 10 years, the markets didn't go anywhere. So that is because the market was anticipating that the capital market, the restrictions that will go away will bring a boom, but it takes time for those things to develop. So what the cumulative impact of whatever reforms were taken in 92 till 2002 started bearing fruits from 2003 onwards, and 2003 to 2008 was one period where we saw a big boom, not only in the markets but actually in the corporate world, where you know the sales CAGR for the 5 years was 25%, PAT CAGR was 37%, and market cap actually boomed 53%. Like index went 7x. I remember very clearly that Sensex went from some 2,900 to 21,000, and those were the days. So so I feel today's...
I missed that period because I joined the stock markets in 2008 on the day when Lehman collapsed. So I missed that whole 2003 to 2008 period. But yes, go on.
Yeah, no, so that was one period where we actually saw the boom, that the promise, the potential that India holds, but has never realized. You know, it has always disappointed the pessimist as well as the optimist. So, but today I feel very optimistic about where India is. I think we are beginning to carve out our own niche in the world. But of course, we have to juxtapose that with what is happening in the US. And US might be in a slightly different cycle than ours.
Okay, so you know, I was just going through the data that you had sent me, right? Since we're talking about the boom period, do you want to, for the benefit of our viewers, share some numbers? How was the banking and as well as the corporate health stacked up in 2003 compared to how it is right now? Is it a very different situation?
Right, no, it's absolutely the most pertinent question. So in 2003, the conditions, what were the kind of conditions? And when we compare with the conditions today, are we also in some similar kind of a situation? If that was the case, then obviously, you know, history never repeats, but it always rhymes. So somewhat similar cycle we can get. Every cycle has its own tune, rhythm to it. So we might not be exactly the same. So even in 2003, the banking sector capital adequacy ratio was about 8-9%. The NPA ratio was at about 4%. It had come down, and even right now our NPA ratios have started coming off, and tier 1 ratios are good. Liquidity conditions, as we all know, were good. Of course, now in the last 6-month period, a lot has changed for the liquidity, but I would still say that it is not as bad and as dire as one would think. But of course, market reacts to the incremental change. So the first reaction to the tightening of liquidity conditions is obviously going to be a correction, and we are going through the correction. But the positive impact of the liquidity in the economy are not going to go away overnight. It's going to linger for a period of time. So liquidity conditions were better than 2003. Banking sector's health was better than 2003. The kind of cumulative reform push that we have seen in the last 7-8 years is as good or can be compared to what happened in the prior post the liberalization period. So I would say that the conditions just before March of 2020 are as were as good as 2002. The biggest thing was, of course, the corporate tax cut, which 25%, and that's like in 2003 that was at 36%. Today we are at 25%. Now this adds all your future profits are going to be taxed as 10% less. That's straight away cash flow addition to whatever future profits you make. So that is probably a secular change in the multiple that India would get, I would say. So if we can maintain growth and we can maintain profitability for a longer period of time, the valuation multiple can actually sustain at a higher level.
But there are other issues, right, that we're dealing with right now, not just the liquidity tap shutting, but also there's global inflation that we're looking at, there's interest rates which are going up. Is the situation very different from what it was prior to 2003? And if you're drawing parallels, are you trying to say that we are at the cusp of a big upcycle?
No, I think we have had the first round of the move itself. It's not like we are now beginning that journey. But what I am trying to say is that this is probably a pause in the cycle. It is not the end of the cycle. It's not like, see, for a cycle to turn over, not only the optimism has to be in the markets, but it has to be in the corporate boardrooms. It has to be in the government psyche where they are announcing plans, projects which are beyond their means, and then suddenly the cycle turns. So today, the corporate balance sheets are very much deleveraged. Nobody is taking loans. Nobody is, okay, there are a few corporates who are taking big loans and announcing big infrastructure projects, but it is not a all-pervasive sentiment where, you know, I'm so bullish on the next 10 years that I'm going to invest 2x of what my capacity is.
Yeah.
So, so that sentiment, that animal spirits is coming back, but it is just the beginning of that animal spirits coming back in the last 4-6 quarters. See, what kickstarts the cycle is the profit. Once company starts making profit over a 4, 6, 8 quarters, then they start thinking about investing for the future. And we have just entered that phase where the companies are now thinking about investing for the future. We haven't yet reached the stage where they have gone ahead and made investments which their balance sheet cannot afford, and there is a downturn. So those are the situation where, you know, the cycles tend to end. So I think we are somewhere in the towards the end of the first phase of the cycle, not towards the end of the cycle. We have a pause in over here, and I think on the ground situation remains positive, and I think will pick up again.
Okay, so you're saying, just to summarize what you said so far, right? This is a market cycle which is a longer upcycle, and we are sort of seeing a bit of a pause at the start of this upcycle. So there's still a lot more to go.
Yes.
All right. Now, if you're talking about this being a boom period similar to what we saw in 2003, 2008, what does a boom period look like in terms of corporate earnings? I mean, what are the trends telling you? Because as far as I see it in Q4, largely it's been inflation hitting, you know, earnings, margins, higher raw material costs. But you tell me, what is the larger trend looking like?
See, first of all, for the boom period to sustain, we have to have earnings growth. We cannot do without that. That's number one. So if you see the corporate profit to GDP peaked in 2008 at about 7%, and it kept falling all the way till 1% in 2020. That 1% has bounced back to about between 3 and 4%. I don't have the exact number as of today, but we can presume to be between 3 and 4%. And so this 3 and 4% is not a stretch by any imagination. Now, because of that initial jump in the profitability, companies have started announcing projects, have started adding capacities. This is leading to the order books being full across the supply chain. I can see on the ground, we track about 200-250 companies very closely, and we can see that they are all brimming with optimism. Nobody is complaining about business not being there. If you just jog back your memory 4-5 years, there was a time where the money was not circulating. You know, there was one after the other problem, GST, demonetization, IL&FS crisis. Everything was reducing the risk-taking appetite of an entrepreneur. Now, today, there is some hit on the margins because of the freight cost, because of the raw material cost or energy cost. But those are, okay, I'm going to make less money, but it's not like I'm starting to make losses or anything. And valuations are correcting themselves because they were factoring in a smooth margin growth as well. So margins have corrected themselves, but there is no problem of growth per se. So once the growth again picks up, there will be some amount of operating leverage that will kick in. See, your fixed cost cannot rise at the same cost. These are all variable costs that are rising. So the fixed cost will remain same, and if the growth comes, your margins will start expanding again. But it will take 1-2 quarters for this impact of the higher energy cost, raw material cost and freight cost to go through the P&L. 2 quarters down the line, we'll see the margin expansion happening again.
Okay, and corporate profit to GDP, you were saying right now, what are the levels compared to what they were?
Between 3 and 4%, and it had peaked at 7% in 2007.
So there's still more to go on the upside.
It could go higher also. Today, US margins are at an all-time high, and they are closer to 9. Corporate profits to GDP is almost 11%.
Okay.
So there is no scientific way to say that 7% is going to be peak, or it can peak out at 4% or no. For the time being, growth in profit has peaked out because of the margin impact. But it should, as I mentioned earlier, because of the operating leverage, the margin will kick back in again. But 3 and 4% is definitely not a very frothy level. The margins still have scope to grow.
Okay, so that's building a really strong case for this being perhaps, a pause and not the end of a market upcycle, right? Got that. Lots to learn. So let's do one thing. Let's take a short commercial break. Don't go anywhere. We'll come back and talk about the big themes that you can look at, the comparisons with previous cycles, and how to make money off this volatility. Stay tuned.